and gentlemen, welcome to the Yeager CPA Review Clarity Project Update. My name is Gary Bulmash. The book that we use, the Wiley book, those of you who do have the book, the biggest change is Module 5, Version 2, excuse me, do not worry about Version 1 in Module 5. Pretty much the rest of the course is the same as it was before. So let's just establish a couple points like that and then get into this. Another point too, in Module 5 Version 2, the multiple choice and simulations have been adjusted to the Clarity Project. However, the test bank simulations may not have been updated. So if there are any simulations on the test bank or the sample exams that they give you, any of those simulations dealing with audit reports would be under the old rules, so do not worry about those. That's in the simulations in the test bank or the test bank exams that are generated. Again, don't worry about a simulation dealing with audit reports, because again, that's the major change. Let's start with a little summary of what I call the players. What organizations issue what, and what are you responsible for? And again, this is sometimes asked in a multiple choice, but usually you will need to know this for a research question. So we'll start with the PCAOB. They issue standards for audits of publicly traded companies, that is, issuers. Remember, on the CPA exam, they use both of those terms. Those standards have not changed. The Clarity Project did not affect PCAOB. So everything from PCAOB is the same as it was before. And again, they have a certain wording of the audit report, so be careful that you're familiar with that. Then we have the AICPA. Under the AICPA, we have the Auditing Standards Board. They're issuing standards for audits of non-public entities, non-issuers. That's our concern here with the Clarity Project. Now, the code is AU, Auditing Standards, dash, and the letter C for clarity. So in past problems where a research question said pick what standards it comes from, and it was AU was the answer for non-public entities, now it's going to be AU-C. Okay, so that's an important point. Now, next point. GAS, Generally Accepted Auditing Standards, covers all the requirements listed herein. It's not the 10 things that we used to say were GAS. It's everything. GAS includes everything in here, all of the audit standards. And what they've done is redo a lot of the standards, and some of them they just kind of cleaned up or made it clearer, easier to read and understand and apply. Some things they made some changes. The expression is that they want it to be more principles-based. That's a good possible test question. So the Clarity Project is supposed to be more principles-based than it was before. What they've done is pretty much rescind a lot of the standards and reissued them as part of SAS 122, different sections. So when you're researching this, you'd pretty much be going to SAS 122, section whatever, dealing with the topic that you're looking for. Okay, we'll start with a general discussion, which comes from SAS 122, section 200, and I'll just mention that, but you don't have to memorize that, obviously. Overall objectives of the auditor, overall objectives. So first is obtain reasonable assurance, and that's a term we've always used, about whether the financial statements are free from material misstatement, whether due to error or fraud. Now, that's the same as before. Reasonable assurance is a high level, but never 100%. We guarantee nothing. And then the next overall objective of the auditor is to issue a report on the financial statements. Now remember, we're auditing financial statements. Now, overall requirements. overall requirements for doing an audit. Ethical requirements. So in other words, this SAS 122, the Clarity Project, pulls in all ethical requirements. They're not specifically cited in here. The ethical requirements are still in ET, the ethics, but they reference ethical requirements. Professional skepticism, remember that means my client is a my client is a crook and I'm going to have to prove it, and that's too negative. My client is a pure sweet little thing and wouldn't do anything wrong, that's too positive. Professional skepticism says get in the middle. Lean toward the negative, though. Professional judgment, everything we do involves professional judgment. Sufficient, appropriate audit evidence and audit risk. Sufficient, appropriate audit evidence and audit risk. And again, these are not new concepts, but they're pulled into overall requirements. Comply with AUC sections relevant to the audit, and meet the objectives of each section. Each AU-C section has its own objectives. So whichever sections apply to you in this particular audit engagement, obviously you have to meet the objectives of that section. Don't try to memorize all of those objectives, obviously, but these are overall requirements and overall objectives. Inherent limitations of an audit. No matter how good things are, they're not perfect. Number one, the nature of financial reporting. A lot of estimates and judgment. Accounting is not an exact science. Number two, nature of audit procedures. We're sampling. We're not looking at 100% of the items. That would be impossible in many cases. Number three, time constraints. That's building in reality here. So these are inherent limitations of an audit. And these things that I was just discussing, overall objectives, overall requirements, inherent limitations, they're all discussed in SAS 122. Another topic discussed in SAS 122, and again, this is by way of introduction for our discussion, preconditions for an audit. In other words, this has to exist. What I'm going to mention now has to exist before you can do an audit. Determine whether the financial reporting framework is acceptable. Now, what do I mean by financial reporting framework? Financial statements could be prepared in accordance with GAAP or IFRS, International, or other possible frameworks, such as income tax basis or cash basis. Obviously, the last two would be for a non-public entity, not a publicly traded company. So generically, we refer to all these as financial reporting framework. So make sure whatever framework the client is using is acceptable, and obtain agreement of management, so this sounds like an engagement letter, that management acknowledges and understands its responsibility. Now, what are the responsibilities? For the preparation and fair presentation of the financial statements, management's responsible for that. They always have been. For design, implementation, and maintenance of internal control, again, management is responsible for that. They always have been. And management is responsible to provide the auditor with access to all information of which management is aware, any additional information the auditor may request, and unrestricted access to persons within the entity. In other words, if the auditor says to management, I need to interview the following people, and management says, no, I'm not going to let you talk to them, then management is violating the engagement letter. That would be, I would say, a scope limitation. That would be grounds to disclaim. But of course, the obvious question is, what are they hiding? Why don't they want you to talk to them? All of this is summarized in an engagement letter. Now, as I said, the biggest change has to do with audit reports. And again, the Clarity Project is effective July 1st, 2013. So with the Wiley book, you're interested in Module 5, Version 2. Do not worry about Version 1. Anything that still exists from Version 1 has been pulled into Version 2. Okay, the basic types of audit reports for a non-public entity. Remember, the Clarity Project is just for a non-public entity. The main one is now called unmodified. Now, I see this as a good test question. Where we used to use the term unqualified, the term is unmodified. Now, let me stress this again. For a non-public entity under the Clarity Project, it's unmodified. If it's a publicly traded company and the audit is under PCAOB standards, then the term unqualified is still appropriate. So for a non-public entity, unmodified, and the opposite of unmodified, and I do not mean this is a silly question, seriously, is modified. And your modifications are the same as before. Qualified, disclaimer, or adverse, and that's also the same for publicly traded companies. Now, you need to know when these different modifications are issued and how they're worded. In your handout, I've reviewed the headings. Audit reports under the Clarity Project will now have little headings. I've reviewed the headings for the different types, and I'm going to go over that now. So let's start with qualified. The key point of, let's back up. Let's start with unmodified. What are the headings of the audit report for unmodified? And these are little subtotals, not subtotals, subtitles within the report. For unmodified, under the Clarity Project, the first paragraph is called Report on Financial Statements. The next one is called Management's Responsibility. And the next part, which might be several paragraphs, is called Auditor's Responsibility. And then we have the opinion. And remember, the essence of an unmodified opinion is the financial statements present fairly in accordance with whatever framework is being used. And then possibly an emphasis of matter paragraph and possibly an other matter paragraph. You may have one, both, or neither of those last two, emphasis of matter and other matter. I will explain them in a little more detail in a few minutes. Now, qualified audit report. The key word in the opinion paragraph is except for. So everything's fairly presented according to the framework, except for such and such an item. So let's go through the different headings in the audit report. We have the report on the financial statements, and you're going to see a lot of parallelism here in terms of the headings. Management's responsibility, auditor's responsibility. Now we need a paragraph called Basis for Qualified Opinion. In other words, you cite the issue here that is leading you to a qualified opinion. And then the next paragraph is called Qualified Opinion. And then again, possibly, if needed, emphasis of matter and possibly other matter. Next, we have adverse. And the key point with adverse is does not present fairly. An adverse opinion is issued for a very major gap departure. The term they use is pervasive. Okay, example. Let's say a company has one major asset, fixed asset, like land and buildings, two major assets. Let's say that management wrote those assets up to a higher appraised value. Assume the amount involved was material. That is not GAAP. Let's say it's intended to be a GAAP financial statement. That is not GAAP under U.S. GAAP. So if the financial statements are supposed to be U.S. GAAP, that is a very major GAAP departure. That's pervasive. So that would lead to an adverse opinion. Go back to qualified for a minute. Qualified except for is issued for a material or a major GAAP departure. And again, when I say GAAP, I mean departure from whatever the framework is that you're using. Or a very major, that is material scope limitation. Now remember the difference. Departure from the framework being used has to do with the way the financial statements are prepared. Scope limitation has to do with your work as the auditor. Scope limitation means you were blocked from gathering some kind of evidence. Okay, so if gap departure or scope limitation, if they're minor, then you could still issue an unmodified opinion. If they cross the line to major or material, and that's a judgment call, then it would lead to a qualified opinion. So it's major departure from the framework or major scope limitation, either one. Very major gap departure, that is very major departure from the framework, would lead to adverse. Now, disclaimer. Disclaimer is no opinion. Why? This is a very major, that is pervasive scope limitation. It's so pervasive that you, the auditor, are basically going to throw your hands up in the air and say, I don't know. Remember, the key question, are the financial statements fairly presented according to this framework, GAP or whatever the framework is? What you're saying here is I could not gather sufficient appropriate evidence. So they might be fairly presented, they might not be, I don't know. I could not gather sufficient evidence. So this is a very major scope limitation, a pervasive scope limitation. If management refuses to sign a representation letter, that is a disclaimer. If management doesn't want to take responsibility, remember the main purpose of a rep letter is that management should take responsibility for their financial statements. If management refuses to take responsibility, why should you, the auditor, take any? So just give them a hug and a kiss and get out of there. So you'd issue a disclaimer. Now, let's go through the headings for the disclaimer report. First of all, report on financial statements, and again, you'll see a parallelism. Management's responsibility, auditor's responsibility, basis for disclaimer of opinion, then disclaimer of opinion, again, that's no opinion, and possibly emphasis of matter and or other matter if you need it. And I don't think I went through the headings for an adverse, so let's do that right now. The headings on an audit report that's an adverse opinion. Again, report on financial statements, management's responsibility, auditor's responsibility, basis for adverse opinion, then adverse opinion, and if needed, emphasis of matter and other matter. Now, for any of these types of opinions, that is unmodified, qualified, adverse, or disclaimer, where you have the headings in the audit report, you may have a last paragraph called report on other legal and regulatory requirements if that situation exists. In most cases, it probably will not exist, but if it does. Okay, so this is a review, again, of the main types of audit reports and when they're issued and essentially how they're worded, but I was just showing you headings. Now, the advice I've always given is memorize the standard unmodified report. Memorize the standard unmodified report and then understand how you vary it to get to the other types of audit reports. And I hate to say memorize, but you have to do that in this case and understand what goes in which paragraphs. Also memorize the standard review report and the standard compilation report. They are not covered. We're not going to cover those tonight. They are covered if you have the book in a different module, Module 6. The Clarity Project did not affect those items because the Clarity Project deals with audit standards for a non-public entity. Now, let's spend a few minutes on the whole subject of emphasis of matter and other matter. And in that respect, emphasis of matter means that paragraph, and it must follow the opinion paragraph, emphasizes something already in the financial statements and or the footnotes. Okay, now, situations where you have to do an emphasis of matter paragraph. One, potential going concern issue. Where there's a potential going concern issue, again, can this entity be in business 1 year from the balance sheet date, and you've cited problems, and you've found out management's plans, and you've compared them, and you, the auditor, have reached a negative conclusion. Then it must be in a footnote, and you must add an extra paragraph to the audit report. It's called an emphasis of matter, where you're emphasizing that footnote. And in that paragraph, you must use 4 words: substantial doubt about the entity's ability to continue as a going concern. Substantial doubt and going concern. So it's clear that you, the auditor, are reaching a negative conclusion. Now, this is the same as before. If there's an inconsistency in the application of the accounting principles being used, in other words, like an accounting change, you have to cite that in an emphasis of matter paragraph. Now, it should be discussed and explained in a footnote to the financial statements. This emphasis of matter paragraph merely emphasizes that footnote. Obviously, it can cross-reference to the footnote, and it should. Uncertainties, like a lawsuit, you do not have to cite this in an emphasis of matter paragraph, but you may want to. But again, it's discussed in a footnote. And remember, the footnotes belong to the financial statements, which are the responsibility of management. Your report, you could emphasize that if you want. You don't have to, but you could. Again, that's the same as before. Or anything else. The standard leaves it open and says anything else you wish to emphasize. For example, you might have an emphasis of matter paragraph that says something like this: as indicated in footnote 7, there's been a major related party transaction. So you can emphasize anything that's already in the financials or footnotes. An other matter paragraph must be included in the following situations. Now, other matter is basically you're introducing something into your report which isn't directly in the financial statements or footnotes. Okay? So sometimes dealing with comparative financial statements under certain circumstances. Okay, so let's say you have comparative financial statements. Now, while SEC does require that for publicly traded companies, U.S. GAAP does not require comparative financial statements, so it would be proper to do a single year. However, in many cases, we do comparative, like at least one prior year. So let's say we have comparative financial statements. The prior year, the financial statements had a qualified opinion for whatever reason, and whatever the problem was corrected. So this year is unmodified, and the correction was made on the prior statements, so unmodified covers both years. When you have comparative statements, your report has to cover all the periods presented. So you're issuing an unmodified report on both years. Now, this could be tricky for some readers. Some readers might pull out last year's and say, wait a minute, last year was qualified because of this and this, whatever. And now you're presenting the last year comparative with this year, and you're saying everything's okay. So we need an other matter paragraph explaining there was an issue last year, management corrected it, and everything's okay now. In other words, close the loop, so to speak. Don't leave readers hanging. Okay, so that's one situation where you have to have an other matter paragraph. Another situation has to do with certain supplementary information. Okay, now, supplementary means information that's presented, but it's not part of the financial statements or footnotes. And by the way, I use the term footnotes to the financial statements, notes to the financial statements, saying the same thing different ways. Supplementary means in addition to the required financial statements, including the notes. Okay, so an other matter paragraph would cite basically what you did on this supplementary information, you know, whether you audited it or didn't audit it or whatever. Remember, we're talking about the Clarity Project, which deals with audit reports. Then there's a category called required supplementary information. This is, again, not part of the financial statements or notes, but it's required by an accounting standard setting body, such as FASB or GASB, something like that. The GASB has a number of items, certain reconciliations, which are required supplementary information. The FASB doesn't really have too much of that. But if any such information exists, then an other matter paragraph is included describing what management has done with that. You know, it's required. Have they included it? Has the information been presented in accordance with the standards? Again, the other matter paragraph would cite that. And any what they call alerts. Alert is the word they now use for what we used to call restricting the use of the report. There are certain circumstances where a report must be restricted. That would be done in an other matter paragraph. Management can elect to restrict, to tell the auditor, or the auditor can elect, I should say, to restrict any report you want. You could put that alert or distribution restriction into any report as an other matter paragraph. What legal bearing will it have? I don't know. But again, you could put it in if you want. They use the term alerts, but it's the distribution restriction. And again, anything else, these are situations where you would have to use the other matter paragraph. Anything else that the auditor wants to use it for, that's fine. If these paragraphs exist, the emphasis of matter paragraph must come after the opinion, and the other matter paragraph must come after emphasis of matter. Now, it's possible to have no emphasis of matter, just have an other matter paragraph. That's possible also. It's also possible to have neither one of those. Now, another subject that's new in this Clarity project is referred to as group audits or group financial statements. The subject isn't new, it's really the terminology that's new. So an example is something like this. We have a parent corporation, and let's, for simplicity, say one subsidiary. In the real world, there's usually a parent company and many subsidiaries. But we'll say a parent company and one subsidiary. Let's say your company, your CPA firm audited the parent company. You are referred to as the group auditor. And another CPA firm audited the subsidiary. They're referred to as the component auditor. Now remember, this is under the Clarity project. The group auditor has responsibilities to be satisfied that the component auditor is independent and certainly competent, et cetera, review their work, et cetera. So terminology is the group auditor and the component auditor. More responsibilities now for the group auditor. Now, by the way, with terminology, the PCAOB still uses the term principal auditor and other auditor. Now, again, some of you are thinking to yourself, when I read a question, how do I know if they mean Clarity Project for a non-public entity or PCAOB for a publicly traded company? You've got to read the question carefully, because they'll usually say issuer or non-issuer. So watch those words, because they become very important and will determine the focus of your thought process. Again, you've got to read carefully, because they throw in words sometimes. They throw in negative words. You've got to read it carefully and think about what they're asking you. So again, under the Clarity Project, the group auditor has a lot of responsibilities. The component auditor is auditing, say, the subsidiary. Now, the rest of this discussion on group audits is similar to what we had before when we talked about shared responsibility. Okay, so the group auditor then has to decide how they're going to write an audit report. One way to write it is just write the traditional report, and the group auditor takes full responsibility for everything. Now, obviously, the group auditor will have received a report from the component auditor or auditors, as the case may be. So group auditor just takes full responsibility, doesn't even mention the others. I mean, I have documentation in the work papers, but doesn't mention in the report. The other situation is share responsibility, and the traditional way this is done is basically the report has to indicate, doesn't have to mention names, but has to indicate the approximate percentage of the work that the component auditor did. Now, what do I mean by percentage? For example, you'd say, we have audited such and such a company. The subsidiary was audited by another auditor who audited revenue composing, I'm making up a number, 10% of the total consolidated revenue, and assets when composing 15%, I made up numbers, of the total consolidated assets. By giving percentages like that, you're giving the reader a clue as to how much responsibility the other auditor, that is the component auditor, is taking. This is called shared responsibility. The term shared responsibility has always existed, but now it's in the context of group auditor and component auditor. So the group auditor writes the report, either takes full responsibility or writes it involving a shared responsibility with the component auditor. As I said before, most of the differences deal with reports. Another thing they discuss are special purpose frameworks. That's a term they use in there. Special purpose frameworks. This would be a framework other than U.S. GAAP. Probably other than IFRS also. Here are the special purpose frameworks. The special purpose frameworks are tax basis, cash or modified cash basis, regulatory basis, or contractual basis. And by the way, if you're using regulatory or contractual basis, you have to have an other matter paragraph with an alert that is a distribution restriction. So these are some examples of special purpose frameworks. We used to use the term OCBOA, other comprehensive base of accounting. Now generically, they're special purpose frameworks. Or another example of a special purpose framework is any framework having substantial support. And that's kind of open-ended and very general, obviously. Now, what I'd like to do is spend a few minutes summarizing some other changes that the Clarity Project made. There weren't many, but I think it's worth summarizing. Again, a good potential test question. First of all, related party disclosures are required no matter what financial reporting framework is used. Now, let's think about that for a minute. You might say, yeah, related party disclosures, it's always been required. It's technically required by U.S. GAAP. So what the Clarity Project did was they said, I don't care what framework you're using, U.S. GAAP, special purpose framework, whatever you're using, even if that framework does not specifically require related party disclosures, they are now being required by the audit standard. So they have to be in there. If they're not in there, that's considered a departure from the framework. Okay, communication with the predecessor auditor. Remember, somebody calls you up and says, I'd like you to do an audit. First question is, why are you switching auditors? And then next, you need to get permission to communicate with the predecessor auditor, permission from the client, obviously. The communication with the predecessor auditor may be written or oral, either one. So I'm emphasizing that written or oral part, which may or may not have been emphasized earlier. The communication rules are the same as they've always been. Okay, now, laws and regulations. Remember, we used to use the term direct effect illegal act and indirect effect illegal act. Well, now the term is laws and regulations. Direct effect means they have a direct effect on the financial statements. The auditor's responsibility is the same as it's been for that, the same as it's been for errors and fraud. You are providing reasonable assurance, that's a high level, not 100%, reasonable assurance that your audit will catch these. Direct effect, laws and regulations, direct effect on the financial statements. You've got to hit it head on. Example, you go to visit with a potential new client, and you say to them, let me see copies of your 3 years prior tax returns. And they say, oh, we haven't filed tax returns. Well, that's dealing with laws and regulations. Obviously, this is illegal. They haven't filed tax returns. This has a direct effect on the financial statements, namely an account, tax liability, tax expense. So that's direct effect. The other one is called other laws and regulations. Other laws and regulations will directly affect operations such as environmental issues, health issues. It'll directly affect something that probably should be a footnote to the financials, but it doesn't directly affect the financials other than the footnotes. They're called other laws and regulations. Now, here's a big difference between Clarity Project and what existed before. Previously, we said with what we called indirect effect illegal acts, now they're called other laws and regulations. You didn't have to deal with it unless it came to your attention. Now we're saying you don't have to hit it head on as much as you do the direct effect, but you have to at least do something. You have to make inquiries of management. Are you subject to any health or environmental, I'm using those examples, regulations? If so, what? Have you gotten any correspondence from regulatory agencies? So you got to hit it a little bit harder up front than you did before. Before it was, if it came to my attention. Now you've got to make inquiries about it. You can't just sit back and say, I'll wait till it falls in my lap. But you don't have to hit the other laws and regulations as much as you hit the direct effect. So I wanted to emphasize that point. Now, one other point. Internal control matters identified in an audit. This is what we used to call the SAS 115 letter. Obviously won't be called that anymore because SAS 115 has been rescinded. It's now incorporated into SAS 122, section number, again, whatever. Please don't try to memorize section numbers. This was a required communication dealing with significant deficiencies and material weaknesses. So let me go over the basic rules and then show you what they've changed. The basic rules are still the same. During the course of the audit, the auditor does not have to search for this, but the auditor will define and identify internal control deficiencies. Some of those will climb up to what are called significant deficiencies, and some of those will climb up to what we call material weaknesses. And the distinction between significant deficiency and material weakness is impact on the financial statements. The communication that is required to be in writing from the auditor to 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 those charged with governance, which is usually the board, the audit committee if there is. In many small companies, it might just be management. What must be included in writing there in that written report is the auditor must identify anything that was considered a significant deficiency and anything that was considered a material weakness. So that stays the same as before. The auditor cannot put in writing, I found no significant deficiencies. You cannot put that in writing, but you can put, we found no material weaknesses. That you can put. Now that's the same as before. Okay, so what have they added? this written communication must now include an explanation of the potential effects of significant deficiencies and material weaknesses identified. That would mean potential effects on the financial statements. Now, the Auditing Standards Board has said they don't see this as a big difference. Why? Previously, the report did not have to cite the potential effects on the financial statements, but the auditor would have had to document that so the auditor could justify why they're calling it a significant deficiency or a material weakness. So the Auditing Standards Board is now merely saying, take what you've documented in terms of these potential effects of significant deficiencies and material weaknesses on the financial statements. Take what you've documented and put it in the report, in that required written report. So that's the new thing they've added there. Now, one other thing they've added. A required communication to management, and I'll come back and explain that in a minute, of any other deficiencies noted. And this can be written or oral. Now, let's think about that. Required communication to management. In other words, this requirement must only, I shouldn't say must. This requirement is only required to go to management. If the CPA wants, the auditor wants to issue this communication to those charged with governance other than management, they may do so. The standard does not prohibit it. It only requires that it goes to management. Whereas the written communication we were talking about earlier must go to those charged with governance and management. Okay, this one, this communication, this new one, is only required to go to management but may go to others, and it includes any other deficiencies. So what would that mean? It sounds like that means anything that was cited as a deficiency, an internal control deficiency, but it did not climb up to a significant deficiency or material weakness, because if it did climb up to a significant deficiency or material weakness, it would have been included in the required written communication that we talked about a few minutes ago. So this is anything else, basically citing it to management, and if you want, to those charged with governance. They're the two new things required here for what used to be called a SAS 115 letter, and that is, in the SAS 115 letter, the explanation of the potential effects of significant deficiencies and material weaknesses, and in another letter, written or oral, only required to go to management but can go to anyone, citing other deficiencies. So that would be other than significant deficiencies and material weaknesses. So that's your basic internal control deficiencies. Now what I've done is summarize the big changes caused by the Clarity Project. And again, the Clarity Project is only for non-public entities. The PCAOB did not jump on board with this. So all discussion relating to PCAOB is now the same as it was before. Non-public entities, the Clarity Project kicks in. Biggest difference, audit reports, and some other differences that I cited. So as usual, when you take the exam, read carefully. Look for important buzzwords that jump off the page. With multiple choice, remember the rule of thumb I've always said. If you read a question and you're convinced there is either no correct answer or more than one correct answer, go back and reread the question and the choices. Somewhere in there is a little word which you might have thought was silly, which now becomes important, which hopefully will jump off the page and make something definitely right or something definitely wrong, as the case may be. For simulations, remember, they're asking the same questions different ways. What you have to do is read it carefully, understand where you are. What are they telling me? Where am I? And what do they want me to do? Where do I have to go? So you got to think of it as, again, they're testing you on the material. It's the same as multiple choice, but they're just testing you a little bit differently in a different manner. But again, it's asking questions, the same question different ways, so to speak. If you're familiar with the material, then you'd be able to deal with what they throw at you. Remember, again, your code for a non-public entity will be AU-C when it deals with audit standards. All the other things are the same as before. AR for SARS, AT for attestation, and PCAOB for publicly traded companies. So all that stays the same. So again, go in there, read carefully, and do the best you can. And good luck to everybody.